Hi guys, and welcome back to Style with Substance, and welcome back to my financial wellness series. Today I have another special guest with me. We are joined by Marvin.
Hey.
Marvin is my cousin, a very good friend of mine, and a very knowledgeable person when it comes to all things finance.
Oh, thank you.
You're welcome. It's alright, he paid me to say that. No, I'm just joking. But today we're going to be talking about investing in company shares, and just kind of breaking it down, really simplifying it for those of you that want to find out more about that route to kind of bringing in an extra income. So if that sounds like the kind of thing you want to learn more about, then please keep watching. So my first question to you, Marvin, is, okay, I personally know not a lot about investing in company shares, but you hear people talk about stocks and shares, and it's just kind of, it's all words. It doesn't really mean a lot. Okay. So when someone talks about investing in company shares, what do they mean? Like, what are company shares?
Okay.
Let's just start right from the beginning.
All right. Company shares are basically a share of a company that is listed on the London Stock Exchange.
Okay.
Okay. And what it means is that you will own a certain percentage of the company.
Okay.
Which, depending on the size of the share that you own or what kind of company it is, will give you certain rights.
Okay.
To how that company is run.
Okay. So you get to make decisions about
you get to vote at the annual shareholder meeting, and you get to vote for people to be on the board and stuff like that. Yeah.
Okay. And so when you own shares, you are essentially a shareholder.
Yeah, you become a shareholder in that company. You can either get share certificates, or you can just hold the shares in online stocks and trades.
Okay, so if somebody wanted to buy shares in a company that's listed on the London Stock Exchange, and we'll say London, it can be the New York Stock Exchange or whatever,
course, or whatever country.
But just for the purposes of an example,
yeah,
how would you go about it? Like, what's the first thing that you need to do?
Okay, my advice would be, if you want to invest in a company, first go and read their financial results, because within that they will tell you how they performed in their last financial year, how they did, if they are going to pay any dividends, which we'll get to later on what that is, and more importantly what their projections are for the year ahead. So once you've gone and done your research on that company, you can then go and proceed to buy shares in it. So the way you would do that is you would need a broker. What I did when I first started out, I just Googled it.
Okay,
that's fair enough. I want to buy shares in this company, and then you just get a list of brokers.
Okay.
And I just chose the cheapest at the time, the cheapest fee.
Okay. So how much do they charge? What is the fee?
I use Halifax. I use them to buy all my shares, and they charge a £12 fee. So no matter how much you buy, it'll be £12. I haven't done it in a while because I just hold my shares in there. But it might have changed. But when I did do it, it was £12, and it was £12 when you buy, and it's £12 when you sell.
Okay. How do you decide how much you want to buy? Like, what's a sensible amount to start with?
Personally, I just felt, how much money do I have that I can afford to lose?
Okay.
Because the thing with shares is you got to understand that they could go up and down.
Okay.
You could be the best broker on the market, but you cannot predict the market.
Yeah.
You know, and it's like for a lot of people, the 2008 crisis was a shock.
Yeah.
And then to other people, they saw it coming.
Okay.
You know, you just can't predict it. So personally, I always invest however much I can afford to lose.
Okay.
Once I get that figure, I then decide, what am I in it for? Because with shares, I feel like you're in it for two things: quick gain or long-term growth. Okay. So a quick gain would be a company that is just started up, and because that's when companies normally get listed on the stock market, that's when they normally are at their peak, or not at their peak as such, but they peak quite quickly. So somebody that is in it for quick gain might want to buy it as soon as they come on, because they know that they're going to increase and then sell quickly.
Okay.
But then long-term growth would be, I'd say, a company such as, for example, let me throw Lloyd's into there. When the financial crisis hit, they hit rock bottom. Their shares were at 20p. If you were looking for quick gains, you probably wouldn't buy those shares, simply because you need to think of it like this. Let's say for the bank to have grown to 40p, they would actually need to double their worth, their net worth. And that's no easy feat. That will take time.
Mm-hmm.
So an investment like that is you're in it for growth.
Yeah.
So you're in it saying, I don't need to see the return right now.
Mm-hmm.
I can wait. I'm happy to wait a few years, and then hopefully the return will be great.
Okay.
And then you also have to decide, am I in it for growth and for long-term investment, or do I also want to get dividends back from it?
Okay.
So I guess you're going to ask me now, what are dividends?
So question number 1. You talked about 2 strategies. Like, are you in it for the long term, or are you in it for quick gain? So maybe take us through those different paths.
Okay, so if you're in it for quick gain, once you've bought the shares, you now own them. So they're in my online account. If I'm in it for quick gains, I'm guessing I'm going to be looking at the markets pretty much every day.
Yeah.
You know, hoping that there's going to be a spike. There's going to be some sort of certain news story that is going to come and help the shares increase in value, so that I can then quickly go and sell.
Okay.
Because what you need to remember is, if you're in it for quick gain and you're looking to sell the shares, there's going to be another shareholder that's looking to sell.
Yeah.
And the more people that are selling, this is going to bring the share price right down.
Okay.
So you got to be the first. You know, if you really want to get the most out of that quick gain, you got to be one of the first to make a move. So it's going to mean that you're going to have to keep up to date with all the news stories, because literally any news story can affect a company's share price. You know, terrorist attacks, you know, being one. Natural events like tsunamis and stuff. Anything can affect the share price. So you need to be a quick mover and focus on, you know, like current affairs and what's going on to make sure that you get the best possible return.
Okay. So question there actually. So if you want to be monitoring everything and you want to be monitoring the share prices. So I have an iPhone.
Okay.
So, you know, there's that bit on your iPhone where you click and it kind of shows you what the stock exchange.
Yes.
Is that the thing that you would monitor?
Yeah,
or are there other apps?
There are other apps. I mean, I use that because I find it pretty handy. I use Bloomberg and I use Yahoo Finance, but there's plenty.
Okay.
There's plenty out there, and there's a lot of journals you can sign up to that will send you weekly newsletters or daily newsletters to keep you up to date. Because you know, sometimes you might be too busy to keep up with everything, and sometimes finding the relevant news is difficult as well. But if you sign up to these sites, they can give you targeted news. Like if you tell them what company you invested in or what kind of segment that company's in, they'll give you the relevant news every day, so you can keep up to date. Yeah.
Okay. And then so if you're in it for quick gain, you'll get that news alert. You'll be like, right, I'm selling, and you'll make well, not a little bit. Ideally, you make a decent amount of money back. And that's that. So if you're in it for long term, what would your strategy per se be?
So I'm a long-term investor. I don't really do things for quick gains simply because I don't have the time to keep up with news, and I feel like you have to put in a lot more effort if you're in it for quick gain. So because I'm a long-term investor, I invest and I leave it there.
Okay.
I leave it there. Like every now and then, I will check up on the news just to make sure that nothing's going to happen. But I pretty much follow more the prospectuses and the information that the company I've invested in are giving out rather than the current affairs.
Okay.
So if I feel like there's anything in their reports that's warning me that ahead, like for example, like profit warnings.
Yeah.
If they say, you know, this year we might not meet our targets, then stuff like that will make me say, okay, is my long-term investment safe?
Okay.
Should I divest now and get all my money back? Or not all my money back, but should I pull out now?
Okay.
Before, because I can see the road ahead is, you know, not looking too great.
Okay.
Yeah.
So you mentioned a word there, divest. When you say divest, what do you mean?
So you invest when you're putting in, and you divest when you're pulling out.
Okay.
And hopefully it won't be too little
Okay.
time.
Okay. So when you say you're a long-term investor, so you've put your money in there, you've left it in there for ages. When you see a return, in what form would that come as? So you mentioned dividends. So maybe now's the time to approach dividends. So what are dividends?
All right. So dividends are a share of the profits that a company gives to the shareholders. So this is what entices investors to your company, because I've invested £1,000 in you, for example, in your company. That £1,000 is there, but your company might not grow.
Okay.
So my £1,000 today might still be worth £1,000 in a year's time.
Okay.
But what will keep me to leave my £1,000 in your company rather than go to another company is the fact that you're going to give me a share of your profits, which is the dividends.
Gotcha.
So it's like, all right, I don't mind keeping my investment there. It's not growing. It's not doubling in size, but I'm getting a share of the profits.
Yeah.
So I'm going to make money back on my investment via those dividends. Okay. Basically, yes.
So it's kind of like a savings account, but you kind of get money back from it every now and again. There's a little bonus.
Yes, exactly that. Yeah. Okay. So not all companies pay dividends.
Okay.
Some companies might pay dividends, and then if they don't make a profit one year, they might not pay it.
Okay.
And it just depends. It just depends on the company.
Okay.
So you got to take that in mind as well.
So why would someone invest in a company that doesn't pay dividends?
Good question. The first company I invested in was Lloyd's, and at the time they weren't paying dividends.
Okay.
I knew that. The reason why I didn't mind that was because I knew, or I felt, because let me not say I know, because no one knows the market, but I felt that their growth prospects were they were at a point where I felt that yes, they might not be paying dividends now, but I know they will be in the future.
Okay.
And at the same time, they're going to grow enough that will make sure that I will get a return on my investment.
Okay.
But if I felt like they weren't going to grow and they're not paying dividends, then I probably wouldn't have invested in them.
Okay.
Yeah.
That's a fair point. So a lot of it is kind of down to your gut feeling. It's kind of down to obviously doing your research.
Yeah.
But the market can be quite unstable, so you never really know.
The market can be volatile. I mean, take example this migration situation that we've got going on in Europe at the moment. That just, I mean, for some people, it came out of nowhere. I guess you could have predicted it, that with war there's going to be mass migration of people, but on the scale that it was, people didn't expect it, and everything's connected. Everything's connected some way. So even the oil crisis that we had, where we saw that the price of oil per barrel, went down to below $30 at one point, and at the time you're thinking, well, that's not going to affect something like a bank. I didn't think it would affect something like a bank.
Yeah.
And the reason why the price of oil went down was because there was too much overproduction. Iran had got their sanctions lifted so that they could now export oil. So everyone's thinking, oh, this is a good thing. But then now that means there's more oil in the market, sent the price down. These oil companies, where do they keep the money? In banks. So that means the banks are going to be affected by the fact that the oil companies now are not making as much money as they were before.
Which means the banks are not making as much
exactly.
money.
So everything's connected some way, somehow. So you do have to take that in consideration, that sometimes you just don't know where the next shock's going to come from. Yeah.
Okay. All right, so we talked about dividends.
Yes.
And now I know that if I was watching, I'd be like, right, so I want the real stats. So let's work with a figure here. So let's say the dividends, I guess companies pay out a percentage of their profits to the shareholders.
Yeah.
And depending on how much shares you get, you'll get the sort of corresponding amount of dividends.
Okay.
So let's have a figure in mind. Let's say you bought, I don't know, is it do you buy 10 shares? I don't know. How would you?
Okay, to keep it simple, we're going to say this company A is selling their shares at £1 a share.
Okay.
I've got £1,000.
Okay.
I'm going to invest £1,000. I'm going to get 1,000 shares.
Okay.
Company A does really good in year one. I've invested them for a year now. I've been a shareholder for a year. Their share price is now at £1.50. So right now, my shares, 1,000 shares, are currently worth 1,500.
Okay.
So we've got that there on the side.
Yeah.
Company A then says, we've made, £1 million. We're going to keep $500,000 for reinvestment into the company to grow the business. The other $500,000 we're going to give it to shareholders, and we're going to give it to them at a rate of, let's say, 5p a share.
Okay.
Yeah.
Okay, so if you have
1,000 shares, that means I'm going to get £50.
Okay.
Yeah. So that's how it works.
Okay.
And
they do that. How often do they pay out dividends? Maximum.
Half year, full year.
Okay.
So twice a year.
Twice a year.
Yeah.
So £50 a year isn't a lot of money.
It is, yes.
So you want to invest more.
Yeah.
Okay.
I mean, another option you have is that if you have dividend, if a company pays dividends, you can choose to get those dividends as reinvested shares, and that is how a lot of successful people who invest in companies really make their money, because they choose to reinvest all their dividends.
Okay.
So it's like they never see the dividends cash.
Yeah.
It just goes in, and that's how they grow their shares. And then because it's like you almost forget about it, especially if you're a long-term investor. 10 years later, you come back and you've got a share portfolio with so much shares, and suddenly you're worth a lot more money.
Okay.
Yeah.
All right. So instead of taking the payout, let's say you 5p a share.
Yeah.
And the shares cost £1. Did you say?
or let's say
Well, they're about
£1.50.
£1.50 now.
Yeah,
So
but you can say
you get your £50 back.
Yeah.
Put your £50 in to buy some more shares, and then you reinvest that. So now you have a few more shares.
Exactly.
And then you just keep
and
building
just keep
it.
doing that, keep doing that,
like
keep
that.
doing that, and eventually you just find it growing almost organically. Without you doing anything.
Okay.
But I like money, so I always say the cash.
Yeah, I would too. But I guess it's a good way to kind of have your money there working for you in the background, and you don't really think about it.
Exactly. Yeah. Exactly that, and I just think that also keep in mind that there are taxes. The government, if you're making money, the government are going to want to make some money too. So there are, you do have to pay taxes on your dividends.